Good morning. Thank you for joining us for our COVID-19 Business Impact webinar today. I'm Whitney Roseborough, one of the marketing coordinators here at Squire. We're excited to have you joining us today. Before we begin, I want to just point out a couple of housekeeping things. We have a Q&A section where you can type in any questions you may have throughout the presentation, and then at the end, our presenter will address as many of those as possible. I have also shared a couple of links over in the Q&A to some of Squire's business resources. Also, I will be sending out an email to all of the attendees with a PDF version of today's presentation, as well as the recording of this entire webinar. Now, let me introduce you to our awesome presenter. Today, we have Megan Bronson. Megan is a CPA and an advisory partner at Squire. She has over a decade of experience working with businesses across several industries, specializing in QuickBooks, consulting, and outsourced accounting services for manufacturing and distribution clients. Take it away, Megan.
Thanks, Whitney. I just wanted to give a little bit of intro into what we're doing today. We are trying to stay relevant and make sure that we get the information out to you guys as timely as possible. So we are doing a forgiveness application update. If you aren't aware, there's recent legislation, and the Treasury has issued a few new documents and rulings and methodologies on some of these things. So while the PPP program is like probably a super boring topic these days, and it is hard to decide whether we want, it's still something to pay attention to. I do think that there's some important things that we've learned through this last bit of updates, and we want to make sure we've called them out and make sure you feel like you know how to move forward best for your business. I do want you to know that, as Whitney mentioned, she'll send all of this out, and with it, my email and contact information will be attached to that. And so you're always welcome to reach out if you feel like you have a specific situation, or if there's something that you need clarified. I'd be happy to get you in contact with our team and make sure we're able to help you out. So our forgiveness application update, just want to review the legislation that happened. So we now have the CARES Flexibility Act. It made some key changes. One is it extends the period to use the funds from 8 weeks all the way to 24 weeks through December 31st. So if you're not aware, June 30th is the last date that you can be approved for a loan, and then by the SBA. And so that's coming up here in a week. So if you haven't applied, please still do that. We do have a situation where if you apply in the next week, your lender still has 10 days to get you the money. And so there is this cutoff of December 31st in case there are any stragglers that end up getting their money in July. And so the December 31st is the cutoff so that this doesn't, keep dragging on forever. You have a decrease in required use of funds for payroll costs. It used to be you had to spend 75% of the loan on payroll costs. Now it's only 60%. So it's giving a little bit more flexibility, hence the name of the act. Those who are able to receive loan forgiveness will be able to still defer their payroll taxes. And then you do, with the headcount analysis that has to be done, you do now have till December 31st to restore your headcount and get people rehired. We all hoped that by next week we'd have a containment on this COVID virus, but it's just not happened. In fact, it seems to be getting worse in some areas. And so the next hope is that you have until December 31st. There is a safe harbor that we'll talk about in another few minutes, but I don't anticipate they're going to extend that further based on the additional safe harbor that we have. So with these safe harbors, you do have the ability to not be penalized for the situation if you are unable to rehire an individual or replace their skill set. So you are encouraged to rehire. If they won't come back, you do need to document that they rejected your offer. Then you have you need to try to rehire for a similar skill set. But if you are unable to, you have that documentation so you won't be penalized. That's the second bullet point of being able to hire similarly qualified employees by December 31st. And then this last one's a new one, inability to return to the same level of business prior to February 15th. We're going to dig deeper into that. This is not a scapegoat type of a clause here. It is if you're unable to return because there are still health restrictions that are keeping your business modified or closed through December 31st. And so anyway, so we'll talk about that more. And we used to have to pay the loan back within 2 years for anything not forgiven, and that has now become that you won't have to pay it back until 5 years. I mean, you might have to make payments along the way, but you won't have to pay it in full till at least 5 years. So that makes even more favorable terms. So let's dig into the details. So with the forgiveness application, they have made some significant updates. So the biggest is that they now have 2 forms. So digging into the 2 different forms, we are going to determine whether you qualify for the easy form or not. If you fall into one of the 3 scenarios we'll discuss, you can ignore the difference is ignoring the FTE and salary reduction analysis. So you don't have to do the whole headcount thing. You don't have to do all of that detailed analysis on those if you can do the easy form. So that besides that, all of the costs that you're spending, everything else is the same. It's literally just the headcount and salary reduction analysis that you get to ignore. So scenario 1, you're a self-employed individual, independent contractor, or sole proprietor, meaning you likely used Form 1040 Schedule C to apply for funding. And you did not include any employee salaries in your average monthly payroll on your application form. And so if you were just your own person, no employees, then you do not have to do the headcount analysis. It doesn't make any sense. You're by yourself. And so you get to do the easy form. So we'll dive into that a little bit later too. Scenario 2 is that you did not reduce annual salary or hourly wages by more than 25% during the covered period compared to Q1 of 2020. So this doesn't apply for anyone that's made over 100 grand in 2019. You know, if someone's making 150 grand and now you're only paying them 100 grand, no, you know, they don't care. The PPP funds limited you to the 100 grand anyway, so they don't care whether there was a decrease. So you don't have to consider them. But for everyone else, did you keep everyone paid? And so annual salary means they still were paid their full salary during the time, or hourly wage is the pay rate. So you might have decreased hours, but if you kept the same wage rate, then you're okay. And the next one is you did not reduce the number of employees or the average paid hours of employees during 2020. So this is where the hours do come into play. And so if you were largely unaffected by COVID from an operations standpoint, everyone's still showing up and working, or working from home is fine too, but you're paying for everyone to keep working, then you don't have to go through all the effort. But you do have to document that you have met these requirements. So behind the scenes, you've got to have that documented, but you are basically on the easy form attesting that this does not apply to you. And so you'll want to pay attention to that, and you essentially have to say, yeah, we don't have this applying. You don't have to go through all the calculations, but yet you have to prove that this doesn't apply possibly later. So it might make sense to go ahead and do the calculations. So we'll talk about those calculations later. And then the third scenario is you didn't change anyone's pay rate, salary or hourly, And this is the health regulations, where if you were unable to operate at the same level of business activity due to compliance with health regulations in place for your local area with COVID. So it does need to be a government or health entity mandate that you are closed for business or that you are modified business. And so those are important things you do have to note. So I've added this little bit in here. I wanted to talk about some takeaways. So what did we learn from the takeaways? I've probably said these things, but I just want to call them out one more time. One, if you applied as a self-employed individual with no employees, go ahead and file the easy form. If you were largely unaffected by COVID from a staffing standpoint, then go ahead and file the easy form. And this last one, the safe harbor, does require documentation of health code restrictions. It is not a free pass for struggling. So if you just run out of work because your industry is something that people aren't going to spend a lot of money on when they don't have the money coming in themselves, it's not necessarily going to give you automatic safe harbor. You do need to show that your business is struggling because of health code restrictions. And so I do think this was designed to help those who really have no control over things. And so I think everyone is going to want to try to meet this safe harbor, but just be careful, because they're gonna go digging into this safe harbor and making sure that it especially if areas are opening back up by December 31st and you're still trying to claim this, they might be trying to come look at your documentation. So be careful with this one. If it applies, great. We're happy that there's a safe harbor for you. But if you're trying to stretch this one, this is one not to play with too liberally. Things we still don't know from that update so far: if you have satisfied the easy form requirements and spent the money needed to receive full forgiveness, can you apply for forgiveness as soon as you'd like, or do you have to wait until the 24 weeks are over? So on the normal form, there is, you do a headcount analysis and you're looking at FTEs for the covered period. So for all 24 weeks, you'd be paying attention to that. So the question is, well, I don't want to wait until December to get this forgiven, right? I've spent my money. I don't have to do a head count because it's just me. Can I get my forgiveness taken care of early? We do not know the answer to that. And it may be that some lenders say, yeah, we'll take it, and others say, no, we're waiting. But until the Treasury rules on this, then we don't know, and it'll have to be up to the lender whether they're going to accept early applications or not. So I'm going to transition now into our next category. That's our spending. So some of the spending updates that have happened. First, we talked about the 24 weeks against the 8 weeks. If you received your disbursement date before June 5th, then you can choose to still use the original 8-week covered period. So a lot of people were really focused on spending their money for the 8 weeks. They got things documented. They were really focused on that. And so if you choose, you can still use the 8-week period. We do have 10 months to file for forgiveness beyond your end of your covered period. So technically, someone who's going to get a covered period through December 31st has until October 31st of 2021 to get this forgiveness applied for. But so you still, even after that 10 months, can choose to do the 8 weeks. So it may turn into finding what's better for you. Is the 8-week covered period a better calculation, or is the 24-week covered period a better calculation? Those are going to be things that you're going to have to analyze as you go after forgiveness. But you do have that choice. If it's after June 5th, that choice is gone. You do have to use the 24 weeks. The alternative covered period, this is for payroll purposes only. It's for convenience. Instead of cutting off on the exact day that you receive the funds, they're allowing you to start your covered period, your alternative covered period, on the beginning of your next payroll cycle, pay period. So if you receive the money on April 20th and your next pay period starts on the April 24th, then you can start your alternative covered period on that day, on April 24th. And then that's where your week by week calculations would come into play for payroll costs. For your other things, for non-payroll costs, that's going to be only on the covered period. So it is kind of confusing, which is why it's really just for convenience. If it helps you out to keep it convenient, then great. If not, then it's not going to be that far different from your covered period, so you might as well just use that. Okay, payroll compensation for employees. So we talked about this before, the gross salary, wages, commissions, tips, paid leave, taxable allowances that are all paid to employees during the covered period or alternative covered period are forgivable. And just to call out, that alternative covered period covers all payroll costs, not just payroll compensation. And it can't be one employee's on covered and another employee's on alternative. Everyone has to be on the same. Your payroll costs are paid and incurred and then paid by the regular payroll date. So let's say your pay period ended on April 23rd, new pay period on April 24th, but you paid on April 30th. You can count April 30th's payroll because it was paid during your covered period. And then you're going to use all the pay periods, that started with April 24th and on. And then at the end of it, your covered period is going to expire, but you can still use that next payroll run that applies because it is incurred. As long as you prove that you paid it out on the next payroll run, you can include those costs that were incurred at the end. So you don't have to do any special payroll runs on the last day in order to get it to work. But essentially you get that early one, and then all the ones during the pay period you'll get. Each employee's wage is limited now to $46,000 if you're doing the 24 weeks. Which is 52 weeks times 24 weeks. And if you choose the 8, you still do have the $15,385 that used to be in play. So that's important to note. Now we used to have our owner employees. We used to think they were treated the same as normal employees, and your owner employees are usually in your S corps. But they are not treating the owner employees the same anymore. So you use the same period as employees, but you're limited to 2.5 months instead of the full 24 weeks. And so you get the 2.5 month equivalent of 2019. So you're capped at the $20,833. This is actually the exact dollar amount of the loan you received as the owner. And so there's no hurt here in this category. That's, you were capped at $20,833 on what you received as loan funds. And so they're just saying that, as you pay yourself as the owner, you only get that much benefit. So owners are tracked and reported separately. And so they are capped at the $20,833. If you do only do the 8 weeks, they're still capped at the $15,385. Just calling that out. That is not different. That's the same as the earlier versions. But the owner employees are treated differently for payroll purposes. If you're self-employed, will use your 2019 applicable compensation. You're going to be limited for the 24 weeks to that same 2.5 months that the owner employees are. And then if you use the 8-week period, you'd be limited to $15,385. So this is whether you have other employees or not. Your portion as the self-employed individual is what's limited. If you have employees, you're going to treat them just like the normal employees, but your portion is going to be limited. And so this is what, this is treated differently than we expected a little bit, but it is the same result in the fact that essentially you're going to get the full amount of loan you received, you're going to get that forgiven. But it's a look back at 2019 more so than, employees are looking at current stuff. So I hope that is clear enough, but we can talk about that in Q&A if you have any additional questions there. Okay, additional payroll costs for employees. You can contribute to the health insurance, including a self-insured plan and employer-sponsored group health plan. It's the employer's contribution. So if an employee has stuff withheld from their paychecks, that you can say, okay, we paid Select Health, 50 grand, but the employee's portion that was withheld was 10 grand. So 40 grand is all that you can put here as employer contributions for the employee health insurance. And then the employer contributions to retirement plans, same thing. If it needs to be just the company match portion, just the employer's portion that is not offset by the employee withholdings. And then your state and local taxes assessed on employee compensation, like state unemployment tax, that is forgivable as an additional payroll cost. For owner employees, this is a new thing as well. This is another area we thought that they'd be treated the same as employees, but they are not. So for employer contributions, these are owner employees. Again, this is like your S Corp owners that are going to be on payroll. They need to make sure that employer portions are included on their wage through payroll. They should have been for 2019, so you should have included the 2019 self-employment, the S Corp health insurance in their 2019 W-2. And so they are saying, well, if you would added it in your W-2, then that means it should be part of wage in 2020. So that does mean that you're going to get this limited. This is owner's health insurance is not going to be an additional deduction for them if they're already hitting the 100K limit. So these are subject to that limit because they're considered part of compensation, not benefits. That is a new development in this round of stuff. And then also the same thing, well, not the same thing, sorry. Employer contributions to owner-employee retirement plans. This is an additional deduction that's available, but it is capped at 2.5 months worth of 2019, not 24 weeks. It is capped at 2.5 months, meaning the loan amount you received for the owner employee benefit portion should be what you get to have forgiven. So that's what's showing up here. And then state and local taxes on the employee compensation, no change from employees, that's treated the same. Self-employed, basically the employer contributions are not included in forgiveness calculations. For retirement plans, you're not including in forgiveness calculations. And for state and local employment taxes, it's not applicable because you're not on payroll. You're not an owner employee. You're not on payroll, so you don't have any of those taxes. So this is not different from what we've had before. This was expected, and you did not get any of this money in your application for those who are self-employed. And so this shouldn't have any effect on your ability to have things forgiven, but we do want to call that out, that it is handled differently than owner employees and normal employees. Our non-payroll costs, we do use the covered period. So as soon as your loan starts, you're either using the 8-week or the 24-week amount. Mortgage interest, rent or lease payments, utility payments. You can catch up. So if you were behind on it and you pay it during the covered period, you'll be able to count that. But and then anything that you have accrued as of the end of your covered period, as long as you pay it on the next billing cycle, you can have that portion be forgiven. And it used to be that the non-payroll costs were limited to 25%, but now they're limited to 40%. So you do have, this area can take up more of your loan forgiveness than it could in previously. That being said, most people are going with the 24 weeks are going to be able to give their loan forgiven almost exclusively with payroll. And so so this area has a lot of gray area. The non-payroll cost has some gray area, but if you're able to get as much of your loan forgiven just through payroll, that's going to be the simplest way to get forgiven. That's going to be the best use of the funds. And so hopefully the gray area won't have to come into play, because you'll have enough solid things through payroll and through lease payments that you'll be able to get fully forgiven without too much extra documentation or proof needed. So here's some takeaways. Owner employees and self-employed individuals can only take forgiveness up to what they received, which was 2.5 months worth of 2019 numbers, versus your employees who can go the full 24 weeks of forgivable compensation. So we talked about that. I'm just calling it out again. We expected the owner employees to be treated the same as employees, but we learned that company paid health benefits must show on the payroll wages and will be included in the 2019 100K limitation. So, so if you are concerned about this, if you are if you're concerned about this, then you ought to pay attention to whether your pay rate has gone higher or lower than 2019. If it is higher than 2019, then it probably doesn't make any sense for you to go through the effort of getting your health insurance added to your payroll account right now. But you'll have plenty of time to make this adjustment, and we can totally talk you through it if you need help understanding how this applies to you specifically. Again, the retirement contributions are limited to 2.5 months of 2019 total retirement contributions. And so you do have to be careful of that you can't just, contribute it away this year on your specific retirement accounts as the owner employee, because they are limiting it to last year's contributions portion. Most of the forgiveness will come from payroll costs. Even with the 60%, I say limitation, really it's more flexible than before. We will likely not need to use much in the non-payroll cost categories, which means we're able to remove areas of uncertainty and simplify the forgiveness and documentation process. I mentioned that before. And then any money not forgiven will be repaid in 5 years. Although there are several of you who have your loan doc saying 2 years, and you will need to amend that with your lender as applicable. If you're getting fully forgiven, then it really doesn't matter what it said. But if you are going to have to pay back some of the loan, then you need to make sure you work with your lender, because the SBA has basically said it's up to you and the lender. You guys can make that adjustment if you so choose. And so some lenders are going to be just fine with that. Others may be a little bit hardball on that. And I don't know if we necessarily are going to be able to control that. And except, with the comment that I guess you were okay with the terms when you signed up, and the bank may say, we're good. You agreed to it. So that's what we're doing. My hope is that the banks will be more lenient on that, and we'll be willing to increase it to 5 years. But I mean, optimally, you're getting everything forgiven anyway, so we don't have to, this won't become an issue. But I do want to call that out in case you are expecting it, it's automatic, because it's not if you already had your loan doc signed. Things we still don't know. We still don't know what transportation means. In the utilities section, it specifically says like water and gas, electricity and telephone, and it says the word transportation. That can mean so many different things, and that's been the most common question on the non-payroll costs is, what does transportation mean? We don't know that yet, and I don't know if they're going to necessarily clarify it because of the increased chance that you don't need to have transportation as a forgiveness deduction, because it's because you'll be able to use up most of the funds with other things. And so this is one of those gray areas where we might not ever learn what it means, but hopefully it doesn't need to come into play. If you are that exception where you do need to know what transportation means, then it'll probably be a matter of following the character of other utilities. So, you know, your electricity, your gas, your water, things like that are measured regular monthly bills. I would expect transportation should follow that same type of characteristic, where it's regular, measurable, and it's another outside entity providing that transportation. So we don't know what it means, but hopefully it's not too much of an impact yet. And then we don't know this other one. We've been wondering about this because the guidance has been different. We don't know whether you have to show payments to self-employed owners in order to receive forgiveness, or if it's automatic forgiveness. So in the prior version of the FAQs and of the application, it made it look like the self-employed owners were going to receive automatic forgiveness for 8 of the 52 weeks. And now that they've increased it 24 weeks and limited you to 2.5 months, it does say show payments to, and it's capped at this amount. And so it does have this verbiage in there that makes us wonder whether we need to actually prove that we paid the owners in order to get that amount forgiven. So if this is the case, then it's going to be as simple as, you know, before the end of the year, pay yourself, and then a week later deposit it back in. I mean, I can't imagine that it has to be something that you keep personally in order for it to count. That's not going to come into play. It just is going to be it's just something that we have to consider. And so you don't want to find that out, you know, 7 or 8 months later, that you never showed any transaction leaving your bank account to yourself because you're keeping all your money in the business to try to keep it afloat. You may need to play a little bit of the paper trail game to show that you paid yourself, and then, oh, you had to turn around and fund the company, so you contributed again to the company. That is not a problem from a tax standpoint or anything. As a self-employed, it would not come into play if you're an owner employee from an S corp. So for partnerships and your Schedule C 1040, you could do this without it having too much effect on taxes at all. There could be a few exceptions to that if there's partnership ordinances saying you can't do something like that, but we're hoping it's automatic. That is the impression we got before, but I'm still throwing it in here as we still don't know for sure on that, because there is language that may make it needing to be proved that you paid your owners. So next category. So we're going to jump into the forgiveness reduction update. So this is your analysis that is needing to be done. So we have a salary reduction analysis that you have to do, and this is where you're paying attention to your rates, your annual salary or your hourly wage rate, your pay rate, where you're comparing to make sure you didn't have a decrease of more than 25% in what you pay your people. And so you are, I mean, there's some like step-by-step things that you analyze it against, but you do have this this safe harbor that if you restore their wage or their salary by December 31st, then this will not apply to you. But it is an employee by employee analysis. So you do need to make sure that you don't have anyone sneaking through that you didn't realize you needed to help. And so I'm not going to go through exactly the step-by-step calculations, but you will have the slide, and we can help you walk through that if you need to. Again, at the top, I mentioned this is for anyone that made $100,000 or more during 2019. You don't have to do this with, because they don't care whether you reduce their wage or not. Even if they were making $101,000 in 2019 and now they're making 70, they don't care. They are saying, well, you received limited funds for their payroll in the first place, so so we don't need you to analyze the pay between them. The next analysis you have to do is your FTE, your full-time equivalent reduction. And so what you're doing is you're taking the weekly hours you paid everyone. So I'm imagining in my head, you've got employees as your rows, and you've got each week's hours as your columns. And so during the either 8 weeks or the 24 weeks, you come up with the average for that time. So if 1 week you paid them 45 hours and the next week you paid them 35 hours, their average would still be 40 hours. So you're going to go through and see what their average is over the period, and then you're going to divide that by 40, and that's either going to equal a 1. You know, in my example, 40 divided by 40 is 1, and so they'd be a 1 full-time equivalent. And then you're going to have to do that same analysis for the comparative reference period, which is either February 15th through June 30th of 19, or January and February of 2020. Or if you're seasonal, you can choose a comparative 12-week period in 2019 between those dates. There is a simplified method. If you have people who are, if you want to say, hey, they work 40 or more hours, they get 1. If they're 39 hours or less, they get half. And so really, as long as you use the same calculation for the comparative period and the current covered period, you're going to get to the same result in knowing whether your FTEs reduced. And so if your comparative period said you had 20 FTEs and your current period says you have 18 FTEs, then you are going to have a reduction there, and that's a reduction of 2. That's a 10% reduction. So therefore, your loan forgiveness, it would take all of your forgiveness amounts, and you would reduce it by 10%. And so essentially 10% of your loan is going to have to get repaid back because of this. And so this could be something that hurts people, especially if we're talking about maybe you've been surviving during COVID without too much adjustment, but things are running out, things are drying up because you've gotten through the backlog of all the work that needed to get done. And so now you're going to experience some reduction in your workforce. And so there is that risk right now that by going the 24 weeks, you might get dinged by this FTE reduction analysis. And so so it is something to be concerned about, but you do have safe harbors here. Well, sorry, first let me talk about the exceptions. This is where we talk about where if you hired or you tried to rehire or restore hours for an employee, but they rejected it, you need to have that in written format. Or if you fired someone, or if they voluntarily resigned, or if they chose to have a reduction in their hours, you get to leave them out of your FTE counts. And so they won't hurt you by having this, but you do have to try to hire a similarly qualified employee for those unfilled positions by December 31st. And so, so you do need to show that you're trying to do that. If someone quits and you do replace them, then you don't get to just count the new person and ignore the old person. They do both need counted, and hopefully will offset each other and create a non-effect. But you don't get the benefit of the new hire if you're really just replacing somebody else. That's something to note on this. And then the safe harbor. We talked about the health code needing to stay closed or modified. That is coming into play here again. It's called out here where maybe you reduce wages for people, but you don't have to take a hit on the FTE side because of this. So even if you didn't qualify for the easy form that we talked about at the very beginning, you could still get this to come help you if you're unable to have restored your workforce because of health reasons. And then your FTE employees, you do have till December 31st to restore that. Even if your covered period ends in October, you would be able to still have till December 31st to get those people rehired. And so that you can say, all right, well, February 15th, I had, 18 people. I need to hire another 1 or 2 people by the end of December in order to meet my FTE safe harbor. So, so there is a lot of opportunity there to get around these reductions. And then we talked about the total forgiveness must be at least 60% attributable to payroll costs. So, we talked about this a little bit, but I gave an example. For a company with a $100,000 loan, and they only have 50 grand in eligible payroll costs, but they have 60 in non-payroll costs, they're going to be limited to forgiveness of only 83,333, which is the 50 grand making up 60% of the total. With their 50K payroll costs fully being forgiven, but the non-payroll costs will be limited to 33,000. The remaining 16 grand of their loan will need to be repaid. And this analysis doesn't matter whether you choose 8 or 24 weeks. It's what costs fall in that period, and they can only make up 40% of the total forgiveness at the end. So some of our takeaways. There, on this note, there is not a 60% cliff. So there was some room for interpretation that there was some fear out there that if you didn't spend, like if you had a $100,000 payroll or loan and you didn't spend at least 60 grand on payroll costs, that you would get 0 forgiveness. And there is no cliff. That the Treasury has clarified that if you only spent the 50 grand, then you're gonna get limited proportionally on non-payroll costs. It is not going to be an all or nothing thing. So in case that was a worry, that is no longer something that is open for interpretation. It is now solidified that it is not a cliff. Things we still don't know. If you have spent the money needed to receive full forgiveness, can you apply for forgiveness as soon as you'd like, or do you have to wait until the 24 weeks are over? The reason for that is, if you've fulfilled everything, you want to get forgiveness now, do you have to wait? They do talk about the covered period, having the FTE analysis across the whole thing. But yet the next line here, the application uses the term earlier of this application date or December 31st. And so does that allow you for you to apply prior to your covered period, or is it really just saying, well, December 31st is the latest any of these calculations apply to. So that's why they're saying the earlier of. If you just need to wait 10 or 12 weeks to spend the full amount, do you have to wait the full 24 weeks, risking that COVID could impact your business in the future in a negative way when you're fine now in that reduction analysis? And so those are the kind of questions. I kind of brought these up already. We don't know if we can get early application. We don't know if that's going to be a lender by lender thing. If they'll allow you to cut it off at 12 weeks instead of doing all 24 weeks. That could be really awesome. I would think that it would be helpful for banks to get that done early, but if not, there is that risk that by the time your covered period ends, you still have to have that FTE satisfied. And if not, you have to hire people by December 31st and prove that you've got them on payroll during that pay period, so that you can show that you met your FTE requirement for that whole period. And so anyway, this could be something that hopefully either we'll get information on that in the future, or it could be as simple as part of our forgiveness calculations, we're checking on both methods. Is the 8-week actually more beneficial? And maybe you couldn't get fully forgiven because you didn't quite spend all the money in the 8 weeks, but yet you don't have to have any reductions, and therefore it's a more favorable calculation. And so we are going to be available and looking at those types of comparisons as we calculate with our clients, and we'd be happy to work with you on that as well. So next, I just kind of want to go ahead and jump over to our Q&A and see what kind of questions we have coming up. So if you have any more, please add them to the list, and we'll get kind of talking through these. We put them into a few different categories. So we're gonna go over to Whitney to go ahead and talk through them, and she's going to be reading out the question, and then I'll go ahead and answer as much as we can. So go ahead, Whitney.
Okay. We're gonna start with PPP spending questions.
Okay.
The first one is CAM, common area maintenance, charged by landlord to be included with rent?
I am going to say yes. To me, that falls under utilities. It may need to be classified different as like your rent portion versus your CAM portion. Your lender might need to see that as a separation there, but I believe it counts as utilities because that's what it's supposed to. I mean, common area maintenance, that to me counts. But that's not specifically listed anywhere. That is my interpretation. So I guess it would be, it could be that a bank pushes back on that. But I do believe that it qualifies. It's with the character of what they're trying to do. And so I do think it will work.
Okay. Next question. What about annual bonus compensation portion that was initially part of loan application, but we're not paying out annual comp until later in the year?
Okay, so right, so you gave someone a bonus that was included in their 2019 W-2, which means you received the funds for that portion, and that could have been very sizable, although every employee was limited to 100 grand. And so when it was just the 8 weeks, we've been talking about saying, just be in the line of your normal timing. If you paid bonuses during that time, then go ahead and pay them out. It's still looking at a limitation on the total. So that limitation of 24 out of 52 weeks is now like the 46 grand. That limitation still applies to the employee as a whole. The timing of that, it doesn't matter whether that was on every single pay period or whether it was one big payout. But if you are going to do bonuses, I would make sure that you have paid that out by the end of your covered period. If you usually paid out December 31st, but your loan covered period, your 24 weeks, ends on November 15th, then I would not, well, unless all of your employees are already maxed out to that 46 grand during the time, I would go ahead and pay out bonus early if you can do that from a cash flow standpoint. You know, there's a few different things that make sense here. You know, from a cash flow, does it make sense to pay that out? But taking advantage of getting that fully forgiven, if you've already got other payroll costs to be fully forgiven, then maybe it doesn't make sense to do it, because you received loan money for 2.5 months, yet this is about a 6-month time period to spend the money. And so so spending it shouldn't be super difficult, even if there were big bonuses involved, because of the limitations that were in place and the likelihood that you can spend it. But there is nothing preventing you from going ahead and sending that or giving a bonus early this year so that it falls within the covered period. There's nothing against that. It really is just going to be for the 24 weeks, limit everyone to 46 grand on the employee side. So I would say do what's best for your company from a cash flow standpoint, number one. Number two, is there wiggle room in what you need forgiven, or have you already been fully have you already achieved full forgiveness because of the 6-month time frame? And then 3, if you have room and you need more forgiven, you might as well pay your employees early with those bonuses, because otherwise you're gonna have to turn around and pay that back to the government. So why not surprise your employees with the early bonus, and then that can help you achieve full forgiveness. So,
okay, let's move on to some forgiveness questions. There's a question that says, getting 100% of forgiveness seems so much easier under the 24-week alternative. Am I missing some interpretation of the calculations? It appears to be much easier.
You're right. It is. The point of this was, it's called the Flexibility Act. The idea was, one, give you more time to spend the money so that hopefully you can achieve full forgiveness even under the current environment of COVID. And then if you are able to achieve forgiveness through just payroll, then go through the documentation for payroll only, and then you don't have to worry about any of the other things, because it is okay for your loan to be forgiven for 100% payroll. You know, you can get all the way down to 60%, but it can be 100% forgiven through payroll. You still do have to do an employee by employee limitation on the 100K. So that 100K divided by 52 times 24, it's limiting every employee to $46,000-ish. And so you do have to do that analysis for every employee. And then you do also have to do that head count and salary and wage reduction. So, I mean, most people aren't reducing wages for people. It's usually an hours cutback than it is a wage cutback. In my experience, what I've seen from my clients. And so the salary reduction is probably not going to be something you have to worry about, but the FTE reduction, you do need to do that calculation, and even if you don't need it to send to the bank because you satisfy it and you're like, I'm good, but you do need to have that documentation behind the scenes so that if you were to get audited, which I should have put this in the slides, but you have to retain your documentation on all these things for 6 years after the loan is repaid. So if you're fully forgiven, then you have your 6 years clock will start ticking. But if you aren't even paying this thing until 5 years is up, then you're talking 11 years from now, you still have to have this documentation. The SBA could come audit you, although they've kind of unofficially said, we're kind of not going to worry about the little guys. We're probably going to go after just those who are 2 million or higher. But still, there's still that chance. And so they do have that documentation retention policy there, saying you have to hold on to this stuff for 6 years after the loan is repaid. And so anyway, so that is, you definitely don't want to be, 7 or 8 years down the road trying to come up with hours from this time frame. So while the application itself is way simplified on the 24-week, and hopefully the source of your forgiveness is simplified, you still do have to do those analysis and have that documentation, so that if you were to get pulled by the SBA to get looked at, you have what you need. So, okay, next.
Okay, thanks. If someone is reasonably let go, does that disqualify them from the easy form?
No, actually, you can still do the easy forms. The safe harbors, where we talked about if somebody is let go, fired, or if they voluntarily quit and you cannot replace them, then you can still do the easy form. That you still do qualify for that.
Okay, and then there's another one along the same lines. It might be the same. It says, if an employee left for another job, does that classify as voluntary resignation?
Yep, that does.
All right. This says they were funded with the PPP loan on April 20th, and our April 1st through 15th payroll hit the bank on April 21st. Can we count that payroll in the covered period since it was incurred before the funding of April 20th?
Yes, it does count. So they are going to look at the date, the pay date that the employees either receive their check or receive the ACH direct deposit in their bank. That as soon as you receive the funds, your covered period started ticking that day. So if you received it on April 20th, the April 21st payroll run would be included, because they are allowing for you to have paid and incurred. And so it was paid on April 21st, it's in the covered period, and then whatever you start incurring after that date is also going to be included. In your case, you would not want to use the alternative. The alternative pay, the alternative covered period would have you wait and start that clock on your next pay cycle, and you probably don't want to miss out on that April 20th payroll run. Or April 21st payroll run. So anyway, so that's something to note there, is that you would use the normal covered period payroll, and it does count. So
okay. All right, 2 more questions. It's Megan said the FTE 10% employee reduction is a reduction on the total loan. I believe the 10% reduction is just a reduction of the qualified expenses. Thus, if you have lots of expenses, like from using the 24-week period, then you should likely be able to get a 100% forgiveness. Is that correct?
I am looking right now to see if there is that determination there. But let's see. But the reduction, I do believe, applies to the forgiveness side of it, not just the eligible expenses. But let me see if I can find that exact verbiage in here, because that is an important designation to make. If you had $500,000 of expenses and you had to take a 10% reduction down to 450 grand, but yet your loan was only for 300 grand, then can you still get fully forgiven? And so let me see if I can look into that. And if I don't see it while we're finishing up these Q&As, then I will include it in what Whitney emails out so that I can get that answered, because that's an important clarification. But I'm thinking it is on the forgiveness side. not on just your expenses. So you can still get dinged with it. So let me look into that.
Okay, perfect. Thanks. We will definitely include this in our email that I will send out later today. And then one last question, Megan, is I am confused by the definition of owner-employee. Does that apply to any entity type? We are a C Corp and a few of our managers do own a significant percentage of the company.
Right, so with a C Corp, the owner employees, they have specifically called out S Corp in that definition. When they called out owner employees, they did specifically say S Corp, but they could have been using that as an example. It could be that you are going to be limited as well as a C Corp owner employee. I don't believe they've clarified that for us yet, of whether it's going to apply to C Corps. Most C Corps, there's really not that much of a public record of who the owners are, and that's why I don't know if they're going to be affected by that. That's a really good question. So again, I'll try to get that answer so that we can send that out with the recording and the presentation. See what I can find there. But it may be something that just isn't clarified yet.
Perfect. Okay, thank you so much, Megan, for all of your insight today. And thank you everyone for joining us. Like we said, we will be sure to send out the live recording as well as the PDF version of Megan's presentation. And be sure to follow us on social media and subscribe to our newsletter, and we will send notifications for future webinars like this. Thanks for joining us.
I actually am going to clarify real quick. Sorry, I didn't get that answer.
Perfect.
So sorry about that. On the FTE, it is a quotient that you come up with. So if you have a 10% reduction, you are taking all of your forgivable costs, and so what your forgiveness amount is, you are doing a reduction to that. So like we talked about, you start with 500 grand and all of your costs. You do a reduction of 10%, so you're at 450 grand. And then that modified total is 450 grand is just compared to your total loan amount. So there is that chance that if you have enough expenses that you would be able to supersede your FTE. So I'm glad that question was asked, because that is a potential. If your total cost comes down to 450 grand with that FTE reduction, but yet your loan was only for 300 grand, then you are essentially not affected by that FTE reduction. So yeah, that is a great call out. I'm glad that was a question, so we can clarify that it's not quite as risky, because hopefully you're getting all those costs accumulated over the 24 weeks. So anyway, that's it. I think I'll get the other one. I'll see what I can find on the C Corp owner employee and get that question answered out there as we email out everything. Whitney, did any more questions come in?
Nope, you have hit them all. Thank you so much.
Thanks, everyone.